Heather has 5 loves in the world. 3 of them, her husband, her 2 girls, the other is compounding interest, and the 5th is what we're talking about in this episode. Find us on the other side of the intro and you'll figure out what it is. Welcome to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. We are talking about HSAs today, health savings account, and what you can do, the quirks, the fun things, the basic things. If you haven't been to our podcast before, we split it into a bunch of sections. We dive deep into content. We talk about questions related to that content, and we share personal and professional things about our lives so you can get to know us a little better. Heather, let's dive in.
I am obsessed with HSAs. Those are health spending accounts. They are like an FSA, but
you got the definition wrong. It's a health savings account.
Oh, health spending, health savings. All right. Whoa. They are a health savings account. I'm sorry. There are so many acronyms in our world. All right. So I am obsessed with HSAs, which are health savings accounts. I actually like them better than the Roth IRA. I was waiting for your reaction. I know. Okay, but there is a big reason. All right, listeners, follow with me. And then I'm going to tell you how to take advantage of these, why I love them, all about it. But the money you contribute to a Roth is after tax money. You don't get a tax deduction, right? Are you all with me? Okay. The difference with an HSA is you get a tax deduction up front. That is a big difference. Okay. That's one. Number 2, it's in its own little bubble, like a retirement account where you can trade and you're not taxed on that, not taxed on dividends, interest. It stays in its own little wrapper as long as you don't pull money out. And then if you pull money out for qualified medical expenses, never taxed. This money is never taxed. And you can invest it. Are you obsessed yet, Dave?
What I'm feeling here is you kind of like it. You're on the fence, but you're leaning more towards liking it.
I love it. I call it the triple tax whopper. I think other people call it that. To be eligible for an HSA, a health savings account, you have to be in a high deductible health plan. So a health insurance plan that is high deductible. Many of them, if you get your health insurance off the marketplace. So yes, even business owners, you can take advantage of this, or self-employed individuals. You just need to be in a high deductible health plan. And they will say most of the time HSA eligible next to them. Then you can contribute up to $4,300 if you are single every year in an HSA, or for family, $8,550. If you're over 55, I have one client taking advantage of this, an extra $1,000. So technically, if you are family and over 55, you could put $9,550 away as a tax deduction of money that is never taxed.
Oh, it is good. One thing I don't like is you can only use it if you use the high deductible health care plan. And for some people, that health insurance doesn't work, or it's not even offered at work. So that's the only downside I see.
Only downside. So the other thing, the reason I like about HSAs is what you don't use, it rolls over every year. So an FSA, which if you heard on our previous episode, I don't get too excited about, because if you don't use it, you lose it. That is not the case with HSAs. They just keep rolling over. So I'm going to talk about myself as an example. I started this with my husband, I don't know, in 2017 or 2018. When we moved back to the US, I was like, we're getting one of these. Again, my husband's like, you're taking more money from my paycheck, blah, blah, blah. All right. Well, now we have, I don't know, $60,000, $65,000 in this HSA that I've invested. We've maxed it out every year, and we've even pulled from it. Now, I only pull from it when we have sizable costs. I can absorb in my cash flow $100 or $200 of copays. I want to pay that out of my cash flow because I want my HSA to grow. But when I had the twins and I had a $10,000 labor bill and our AC went out and I was also paying for a night nurse, I pulled that $10,000 out of my HSA. Tax-free. It's amazing. It's absolutely amazing. And my clients that are in retirement that have HSAs, that they started them, we are using those suckers because if some of my clients are retired before 65 and they are in these high deductible health plans, to save on premiums, and we are using that HSA and it's really helping keep their tax bracket low.
You mentioned someone being 65. That's kind of a key age for HSAs. Let me take you through that because people listen to you. Now they got to listen to me. So if you are deferring money all the way through your career and you're like, shoot, but I can only pull this out for medical expenses. Like I'm kind of stuck. And now you may have a 6-figure HSA. Well, when you get to the age of 65, that restriction gets pulled off. You can use this like a traditional IRA. So it's almost like having another retirement account that you can contribute to. So if you're 65 and you've got medical expenses, same as it's always been, take it out, not paying taxes on it. If you need it for living expenses, that's cool too. You just have to pay the taxes on the money that you take out.
Do you know what's crazy though, on an awesome trick for that though, is for all these little copays or receipts that I'm choosing to pay with my taxable income right now because I want my HSA to grow. I don't want to reimburse myself from the HSA unless it's a very sizable bill. I am saving those receipts and you can reimburse yourself at any time from the HSA. So let's say Heather becomes 65. I'm 38, I believe. So let's say I have 20, how many years in that? 23 years or something. I don't know. 20. I can't do the math. Why I'm
good math.
Right.
Keep going. Yep.
27, something like that. Years of unreimbursed medical expenses. And I can just reimburse myself tax-free when I'm 65.
Is it unlimited? Like there's no time span on it?
Isn't that insane? The
Do you
HSA
think there will be at some point?
I'm sure I'm wondering there's going to have to be, but there is just so many things I keep finding out about this. And then, I have 2 girls, a husband, knock on wood, we're pretty healthy. I will say our deductible as a family is very high. I think it is $10,000. So it is very insane, but I find most of the time I go to my concierge doctor because I want good medical care, and preventative is covered. So my checkup, my woman medical exam, my girls' annual checkups are already covered. They don't even go towards a deductible, right? So unless we had a health event, knock on wood, we haven't, we just get to go put money in our HSA and pay the lower premium.
I could see us doing this when my children are off my health insurance.
You and the boys.
Put that in a nice
you
way.
And the boys.
When I don't have to pay for broken bones and x-rays and MRIs just because of sports and, we pick a fight with a moving car, stuff like that. When it's me and Sarah, it'd be like, sure, let's just do this.
So if you're healthy, you don't really go to the doctor very often. They are amazing. I am obsessed with HSAs. I also learned this other trick as I was researching. A client has a weird fiscal year, like the company does, where their enrollment is mid-year. But there's this little weird rule that if you're enrolled in a high deductible health plan in the last month of the year, it's as if you were enrolled the whole year and you can max out in that tax year. Like, that's amazing. Now, you have to stay in the high deductible health plan for the full next year, right? But that's a really cool trick too. I didn't know that. There's so much weird little nuances.
With it being benefits enrollment period, if you choose the high deduct, if you're going from a PPO to a HDHP, acronyms flying everywhere. But if you choose that in November, December, you can just pre-fund that for the full year that you're currently in and then go into the next year.
No, because it's when you are in the high deductible health plan. Selecting it, I think people get confused about this. Selecting it, but when you are actually enrolled are two different things, right? When we're doing, most of the time, I'll say, when I'm going through benefits enrollment with my clients right now, we are selecting for tax year 2026 or calendar year 2026. They won't be in that health plan until 1/1, so that doesn't count. But this client that I'm talking about, they got actually put in this new high deductible health plan in September It was very weird. That's when they switched plans. So on 12/1, they are going to be in that high deductible health plan.
So this might not work for people who are changing benefits on a normal schedule, like normal fiscal year, but it could work for people who are on the weird fiscal years, or it can work for someone who is joining a company late in the year because that is a special period of time that they can enroll.
Yes. And a few little weird things that people don't know too about HSAs is you have until 4/15, like the tax deadline, to contribute for the previous tax year. So you can still be contributing for 2025 through 4/15/2026.
So that's easy for the business owners. Hard if you're in corporate America trying to figure out, can I prorate this payment in 2026 to fund 25? Payroll's going to hate you. Yeah, and it might not even be an option.
Yeah, you have to talk to HR. I'm sure it depends on their policies. The thing that I think people mess up, though, a little bit on HSAs that I want to add in is I see a lot of times, which is also why I like them, is if you select a high deductible health plan, HSA option and benefits enrollment, the employer will contribute many times to your HSA. It'll be a little benefit. Let's say $500 or $1,000 a year. So in 2025, the max for family is $8,550. You're with me, everyone? So let's say your employer, ABC Co., puts $1,000 in your HSA through the year. That means you can actually only contribute $7,550. The max of the HSA, what I'm trying to say, is the max. That is the max in total that can go into an HSA in your name. Employer and employee contributions. You can't, it's not like you can put $8,550 and then the employer can go put money on top. And so this becomes very important if you move employers throughout the calendar year. I will have to review, whoa, like you've already almost maxed out your HSA. We have to be very careful over on new employer to only put X amount so that we don't over contribute. Because I have had to do the fun game of unraveling an excess HSA contribution with a client's like HR department. And it's doable, but it's not fun. And it's just unnecessary work you want to avoid, an unnecessary headache.
I've got an HSA 2.0 planning point. This is going to get a little complex that I have to put a slide on the screen. And this is what happens with the HSA when you die. You can leave beneficiaries on your HSA. So it can be your spouse, children, trust, whatever you want it to be. But let's look at this slide because there's three options. If you are leaving your HSA to someone, you can leave it to your estate as a default. That sometimes works out well, sometimes it doesn't. Let me take you through the two ways it works well and way it doesn't work well. So let's say that you are leaving it to your child. Your child earns a lot of money. When they inherit the HSA has to be liquidated. They can't keep it for themselves. So if you're in a 10% tax bracket and your child's in a 37, it's just going to be taxed at a huge tax bracket. So you should be leaving that HSA to your estate, and they can take a distribution from the estate and it doesn't get taxed at their tax bracket. The other way around pretty much flips. If you're in a 37% tax bracket and your child's in a 10, make sure that they are named as the HSA beneficiary, because then that distribution then get taxed at their tax rate versus a high one. There we go.
Dave, have I convinced you to want to do an HSA one day? Do you love them now as much as I do?
One day. I need a long track record of my child not going to the ER.
But if you had
it's not happening right now.
But if you had an HSA with like 10 grand and you could just pay the ER bill $1,000, not that bad. Pre-tax.
We just switched over to employer paid health insurance. It's a perk that Sarah gets with her job.
Do you know
so it's going to be hard to give that up. Before we move on to the next section of our podcast, you need to help us, please. If you can, comment, follow, like, subscribe, send it to your mom, put it in the boys and girls group chat. That'll be awesome. If this is your first time here, you don't have to worry about that. If this is your second or more time here, please do one of those. Make sure that we can get this channel and content out to as many people as we can. Thank you. We are moving to the next segment. It is called What Would You Do? This is the question section of our podcast. Question number 1. I am changing jobs this year. What happens to my HSA?
It's like a retirement account. I mean, it can either stay there depending on the company's policy, or you roll it over. I would probably roll it over unless your new employer has really expensive investment options. It's very similar to a 401k, how I decide whether to roll it over or not.
So that's pretty much it. Nice and easy.
I am contributing to my account, but not withdrawing any money. Can I invest the money? Oh, Dave, answer this.
Yes, this is something that I sometimes don't think about telling people because I think it's just a given. But no, your money does not have to sit in cash in an HSA. You can invest this account aggressively too. I typically tell people, if you're planning or you think you might use some of these funds during the year, keep some of it in cash. Invest the rest. So, I don't know, keep your copay or your deductible in cash for the year. And then all the investments going forward, invest it aggressively, because I would like you not to be touching this account. So you got a long time to write out the investment up and downs.
Yes. And I have seen with many of my clients, with their employers, they all have a different minimum. I think my husband's company requires us to have $2,000 cash no matter what. And then everything else can be invested. Sometimes they have their own minimums. So we have to find that out.
Question number 3. I am 65 and retired, and Medicare mostly covers my medical expenses. How can I get access to the money in my HSA?
This is a good one. Use it for dental and vision. I think people forget that it doesn't just have to, it's qualified medical expenses. That includes dental work, that includes, vision, that includes many different things.
You're 65 in this question, so healthcare is not the only thing you can use it for.
Yeah.
So this is now a regular account that if you don't have the medical expenses, you can take it out and just pay the taxes on it, like an IRA or 401k.
I will tell you though, my clients, as they get older, the dental costs they get high. And dental insurance, I don't get very excited about. It doesn't cover very much. It's normally like, we'll cover up to $2,000. And when you have a dental event, it's like $10,000. It's kind of funny.
Yeah, we'll pay for half a crown. All right, we're going into highlights. This is the section of our podcast where you get to learn about us personally or professionally. Heather, you're going first.
So last week, I got to meet Lisa, my employee, for the first time in person.
That's
really cool. Yeah. And we actually had a really, really good visit. She was apparently really scared that I wasn't going to like her. I'm like, we've been working together for over a year, but we had a great time. It was really fun to actually work side by side and meet her in person. I think it really strengthened our working relationship. And yeah, it just kind of felt comfortable, which I was really happy. Our house was just being finished and I took her in and she was like, are you sure? And like, you haven't even seen it yet. Are you sure? I'm like, yeah, like it kind of is what it is at this point. And then we worked in my office and, my contractors are going in. We went out to dinner with you and my husband. I mean, it was really a good visit and I'm on a high from that. I'm happy.
Awesome. That was good. All right. My highlight of the week. This is a little bit vulnerable. I have been really enjoying being a dad recently. I didn't really enjoy it too much when the kids were little. It was the case of, okay, how do I balance building a business, being a dad, covering for Sarah who's at school, if the kids are sick? Like, it was a real push and pull of business owner, dad. Now I'm like, whatever, business will do what it'll do. And if I want to go watch one of the kids play football, I'll just go do it. And I'll just come back and work. Now I don't feel that push pull. So it's been really nice to actually get to that place where I'm okay with everything going on in life.
I'm jealous. I think I'm still in that because I think when kids are younger, they need a lot more from you. Like right now, and I'm in this phase. I don't know if you remember this, but it's like still they need my physical help. They can't feed themselves, do everything themselves, but also it's emotional now. Granted, I have girls. So it's like a double whammy right now. So I'm very happy for you. I feel like I'm always envious of you where you are with your kids. You seem very balanced. I'm like, oh, you're so farther along. I shouldn't really rush it. I know every parent says it goes really fast, but.
Thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, or if you want to watch us, we're on Spotify, YouTube, LinkedIn, Instagram. Someone convinced us to go on Snapchat. We'll probably be there too. But if you want to send us a question, you can do. We are reachable at hello@playbookotw.com, and we'll see you next time.
Toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.